Welcome to Mongo Spaces. I will be unpacking the medium-term note from EABL and just giving you a breakdown on what it is and what it involves and how you can get to participate and how it relates to you as an investment. So with us here today is Rispa. She's a regular at Mongo Capital Spaces for a while. Rispa, maybe for those who don't know you, and there must be very few, maybe you can introduce yourself.
Good evening or good morning or good afternoon, depending on where you are. My name is Rispa Genga Ohaga. I'm the Group CFO at East African Breweries PLC.
And how's it been in terms of day-to-day? What do CFOs do?
It's intense. I always tell you there's no day to day. Every day is a different thing. And so you just have to be on the ball, making sure you're delivering, because we're here to make sure that the business is delivering and delivering to all stakeholders.
I know day-to-day is different, but there's something called working capital in a business like EABL. How does that look like? How do you define that for someone who's not aware of what working capital is?
So working capital, you might know I was previously a banker, which is quite different from when you're in industry like EABL. And for us at EABL, working capital management, and I know this is true of most businesses, is absolutely critical. It's a lifeline to any business. So it's how you manage your sales when you sell, how do you collect when you're paying, how do you pay out, and how do you make sure all of that is efficient. If you're buying inventory, you make sure that you're buying just enough. You don't have too much of your money held up in inventory. You don't have too much money held up in debt that your customers owe you. And neither are you in a position where you're paying too quickly before you collect. So it's really balancing those dynamics to make sure that as you sell, you're converting that into cash, because for every business, the most important thing is cash, even more important than profit. And part of working capital management is funding, and which involves the use of debt or equity to help drive the business, because you need money to be able to pre-buy materials to produce goods to sell to your customers. And then you collect from the customers, and on the cycle goes.
You say you can either fund it through equity and or debt in terms of cost of capital. What makes you lean on one and not the other?
Equity is quite expensive to raise, and you raise it at the outset of the business. And then later on, you have the option to go back in for more, which is quite a process. Whereas debt is also a balance, and you also have your own generated cash. A lot of our businesses are capital intensive. We have very expensive plant and machinery, which you have to fund. And so that's where you look at debt as a means of funding your business, always making sure that you monitor the level of debt to make sure that it is sustainable for your business. And we use a number of ratios to look at that, one of which is most critical is net debt to EBITDA. We look at also debt to equity ratios. We look at interest coverage to make sure that the amount of debt we are carrying is optimal, and that also we are converting cash quite quickly to be able to sustain the business. So debt generally is cheaper than equity, and also it's quicker to raise. And you can get that through banks. You can also get it through the capital markets, as we're doing now.
And then with debt, I know a lot of Kenyans, when they hear debt, it's all about auctioning your properties at the end of the day in terms of failure to pay. But debt is a critical component if you're running a business. You're taking short-term loans here and there or something like that. Could you explain the context in which debt is good for business?
So debt is good when you're clear on what you're using it for and how you're going to pay it. And so that's why I say when we look at things like our interest cover is just a ratio that says, out of my profits, how many times can I cover the interest? And similarly, there's debt cover. I should be able to calculate how many times my profit is able to cover the cost of debt, both principal and interest. So you should make sure that your debt is generating as much cash as possible. And the number for interest cover is 4 times. Your profit should be at least 4 times the interest that you have to pay. So you do measure yourself by that. If you're finding that the weight of your debt is too high, your service costs are too high, then you need to revisit and look at your balance sheet. So a lot of that is balance sheet structuring. It's also risk management. We've seen in the last few years the fluctuations in rates, and when rates fluctuate, say from 8 or 9% where they are now to 20%, 23% where we saw them last year, that can cause immense strain to the business. So using risk management tools, you can then work on how much of your debt is fixed, how much of your debt is floating. Otherwise, some of those fluctuations can result in your profitability and your cash being very volatile and therefore being very difficult to manage for your business. So really being legible about your numbers knowledgeable about your balance sheet, your P&L, but most importantly about your cash and your cash generation, collection, and utilization is very important for any business, whether big or small.
How does it look like in terms of financials from the latest? As maybe a brief overview to give context to our discussion in terms of the medium term note that is coming up. How are the latest financials looking like?
So our year end is June. We announced our results at the end of June, and a very credible set of results that we produced there. You will see that at an organic level, we grew sales 10%. In our industry, that is a really strong delivery, and you can see that the growth in Uganda and Tanzania way faster than Kenya, but across the piece, we saw some really decent growth on the top line. That, when we look at it going all the way down, translated to 12% growth in profit after tax. But most importantly, we really generated strong cash. We ended the year with 12.7 billion in cash. We generated 35.7 billion in cash just from our operations. And you can see that we used that to pay interest, to pay taxes, to pay down some of our debt, and to pay dividends. And at the end of the day, we still had 12.7 billion, which shows you just the strength of the business that we have. When you look at our ratios, equally very strong. We came out with a current ratio above 1, which is a very strong indicator. Again, net debt to EBITDA very low. You start to see pressure when it gets to 3. Ours was at just about 1.1, and interest coverage was 5.5. So very strong ratios, and strong ratios that we've managed to sustain over time despite the ups and downs of business. So a really very credible result. We ended up paying 8 shillings per share on dividends as well. And with that, we also reduced our debt by 9 billion shillings. 2 years ago, we had about 59 billion shillings in debt. At the end of the financial year, that had come down to 39 billion. And when you look at that from a key ratios perspective, again, very strong. So very deliberate action to manage the risk in our balance sheet, to make sure our business is strong. Our balance sheet is very strong as well to support growth and to deliver the profits and the cash that we need.
In terms of redeeming and launching a new tranche, now, what is the context to that? What makes you redeem one note? You just redeemed an 11 billion note and you're in the market for 20 billion, and 11 billion is past tranche. So maybe you can give context to why you redeem one debt and then take up another debt, so to speak.
And all of that, as I said, is really managing the balance sheet. And one of the things I talked about is the fluctuations in rates that we saw. And we continue to see our economies are quite volatile, and that across the piece with the variations in interest rates. So one of the things we do is to make sure that we've got a really good mix of fixed and floating debt. And in the last 4 years, we've held 11 billion in a medium-term note that was fixed rate at 12.25%. What that did is that it protected us when rates went as high as 23%, and it kept our interest cost on that portion quite stable. And therefore, we only had to deal with the rest of the book, which was then fluctuating in rates. So that was due to mature next year in October. And we consistently review our debt book. We review for opportunities to structure, which meant we would have needed to fix another portion for another period. So we've been looking at that and saying, what's the right time to go back in? Equally, there's a timeline within which, if we wanted to redeem, it has to be done at an interest repayment period. So that was on October the 29th. If we missed that, then we'd have had to go for March. So again, making sure that all of that happened within the window. So quite a delicate exercise of saying, one, we still feel good in that we need to hold some level of fixed rate debt in our book to manage interest rate risk and volatility. But 2, we also need to make sure that debt, as it is coming current, it is refinanced and we sustain that mix. And then thirdly, that we do that within the timeframes, within the contracting documents that required us to pay down at an interest payment period. So that was the thinking around it. And also looking at the rates right now, we felt that it was a good time to go in and fix for another 5 years. So in summary, the note was coming to maturity. In terms of timing, it was a good time to come back into the market. And thirdly, redeeming it early allowed it not to fall into current. And the timing was right for us to get a fairly decent rate to fix and maintain the same mix of fixed and floating debt.
The previous note carried an interest rate around 12.25%, if my numbers are correct. And then now you're issuing at 11.8%. Is that informed by the interest rate in the market? Which has also significantly gone down since 2021 to 2025.
Yes, precisely. And that's one of the things that we watch out for is to say what's a good time to go in. And you go in, none of these things are guaranteed. And you go in when you think that this is a good time to lock in. Now, who knows if in the outer years rates will go further down or they will go further up. You make your best judgment call and say, whatever happens, whether up or down, that I will be able to have this at a fixed rate of 11.8, which will still be fair enough and decent. And then the rest of my book will be floating, which then will manage as the environment changes. So really, it is cost saving, but more it's a risk management perspective to manage volatility on the P&L and to give the balance sheet stability.
How much in terms of finance cost savings are you looking at here once you issue this new note?
It's quite notional if you think about it. If it's just for the 1 year to next year when it was maturing, which is the only amount, the only period you can guarantee, that's just about 45.9 million shillings in the 1 year. But again, because you don't know, the outer years rates could go higher or lower, then that will depend. We've done some simulations to see what do we expect, what are the fluctuations expected to be, and none of that. We don't have a crystal ball, but we do our simulations and say over the next 5 years, we feel it's worth taking the risk and locking in at 11.8%, again, for their predictability. So as I say, interest savings, yes, in the first 1 year, there's an interest saving, but it's more around risk management and making sure that we also don't release a very good set of results 1 minute and then the next half there's a very poor set of results because of interest rate fluctuation. So we want to manage that to ensure sustainability of results and predictability of outcomes.
And then in terms of tenure, also 5 year, and then the staggering of the maturities. So what makes you issue first the tranche that is 11 billion and then maybe wait 9 billion for later? What's your thinking around that?
And the thinking is that an MTN is an intensive exercise. If Robert was here, he'd tell you we probably started around about February really making this decision. And it is intense in terms of time, input, cost, approvals. And one of the things we've learned from previous issues is allow yourself room so that if you do want to go back in, then you have a bigger program under which you can go and ask for more money than to lock it in at just what you need now. And then if you needed more, you have to go through the whole process all over again. So all it does is make it easier for us to access the capital markets should we need to. It does not mean that we are increasing our debt level. All it does is make sure that we are efficient in this process. We're doing all this work, so might as well do it for a sizable amount. If we need it, then we'll come for it. If we don't, then there's no loss to us, really.
So it's more of to think of the 9 billion as a green shoe option. You're just creating optionality in terms of if you want to or if you're able to, you can tap into that. If not, you let it lapse, right?
Yeah, absolutely. So imagine if next year or the year after we go into an interest rate environment like we saw in 2023-24 where rates go up to 20%, you can choose to go. If you're seeing that, you can go in before it gets to 23-24% and still lock in before the curve goes higher. So it just still gives that optionality, and still it allows you the flexibility to do fixed, floating, etc. So it just gives us the optionality to go back in, and you're right, it's a green shoe option.
Someone perhaps who's listening would be wondering what's a note and what's the difference between that and a bond. Any thoughts on that?
No, I was going to tell Robert to take that.
Robert has just joined us. Robert, please introduce yourself and then let us know what you do at ABSA.
So my name is Robert Murai and I head up capital markets for East Africa at ABSA Bank Kenya. So ABSA Bank is a tier 1 bank offering a comprehensive range of services that include retail banking, corporate investment banking, business banking and wealth management. And we're also part of the ABSA group, which is a leading financial services provider headquartered in South Africa. We have operations in 10 African countries and international offices in Europe, Asia, and North America. I think just generally as ABSA, we are committed to deepening the capital markets by delivering innovative financial solutions, supporting issuers such as EABL and investors across the continent. Perhaps we just repeat the question.
It's a light note question. Why is it called a medium-term note and not a bond?
Okay, the word note and bond are really interchangeable, but I think for this particular transaction, so it's what we call a bond program, which essentially allows EABL to issue several bonds or notes using the same documentation. So the advantage of that is that you get approval once from the regulators. And I think as Rispa had mentioned before, in this case, we have a 20 billion shilling note program where EABL are looking to raise 11 billion shillings but were able to come back to the market for, say, the additional line, then they can go back to the market using the same documentation. So that's really it. It provides more flexibility, allows EABL to issue different bonds with different commercial terms.
Could you walk us through the process of perhaps starting to think through we should redeem and then we should maybe issue one and issue perhaps with an option to maybe take up a bit more than what is being offered in the market? How does that process usually look like from your transaction point of view?
Okay, from a transaction point of view, so typically what happens, so maybe I'll give the example with EABL, where we had a lot of discussions, we gave a lot of proposals, and we were aware that EABL were looking to come back to the market and to potentially redeem the bond. But at the same time, speaking to the EABL senior management, we were also aware that they may want to increase the overall size of the program without necessarily having to go back and do, as Ingrid mentioned, that the process takes quite a bit of time in terms of putting together the documentation. So I think together with EABL, we did come up with the decision to set up a larger program so that when rates are conducive, when the time is right, EABL can essentially just go back to the market without necessarily having to go through the entire documentation process again. So really, the idea is to make it easier for the issuer or the client to make quick commercial decisions when it comes to raising debt via the capital markets. And by setting up a program larger than the amount you want to issue initially, it just provides a lot of flexibility and saves a lot of time.
You've spoken to the quantum aspect of it. How do you come up with the interest rate aspect of it now? 11.8 versus 12 or 10 or single digits. So what usually informs that decision of how much you should charge?
Okay, for this particular issuance, what we essentially did with EABL is to try to determine the right price. And that was a mix of looking at the various yield curves that we have in the market, as well as having very comprehensive discussion with investors. And by doing that, we're able to determine an appropriate all-in price, which aimed to reflect essentially EABL's strong credit profile, while also ensuring the pricing remains attractive to investors from a returns perspective. So it's essentially both a factor of looking at where the yield curve is and also engaging investors to determine the right price to issue.
And then for investors here, they're looking at what kind of effective yields will they invest in the note at the end of the day.
Well, I guess the interesting thing when it comes to the yield curve at the moment is that the implied government yield curve varies depending on who you ask. So that's why, as mentioned before, we focused really on the all-in rate, which once again we developed through looking at the yield curve, but I think also more importantly, speaking directly with investors just to ensure alignment with the prevailing market expectations for top-tier issuers such as EABL. So it's essentially almost we play a role where we bring what EABL want and also what investors want, and it involves a lot of discussions with investors in terms of from a price perspective, but also looking at the quality name that is EABL and just finding a balance between the returns expected by investors, but also the price that would work for EABL. So it's really looking at both sides. It takes quite a bit of time, but that's how we essentially come up with the price.
So what are the key dates that investors should pay attention to, and perhaps you can tell them the process by which they can participate in the note?
In terms of the key dates, so the offer opened on the 27th of October, so that was last week, Monday. So it will be closing on the 10th of November. So that's this coming Monday. Then once it closes, then what will happen is we will then commence the allocation process internally with EABL and other advisors to the transaction, after which we will then notify the rest investors in terms of the allocation and then advise on the date of payment. So that should all be completed by the 18th of this month. And then finally, just in terms of ways to invest, there are two ways. So number one is to invest online. So there's a portal that has been made available to investors. You can also find the portal on the EABL website. And you can also get in touch directly with ABSA, where we can direct you in terms of how to invest. And then the second part, you can also invest via physical forms. And through that, once again, you can engage ABSA Bank Kenya or ABSA Securities to get those details.
Now, what's the minimum investment? What are they looking at? When should they avail the funds? Is it when they're applying or just a bit later when you make the call for the capital itself?
In terms of the minimum amount, so the great thing is that the minimum amount is low. So it's 10,000 shillings. Traditionally, it's always been 100,000 shillings for bond issues, but I think working together with the CMA, it's now been dropped to 10,000 shillings. So what this means is essentially it's now available to a wider range of investors, which I think is quite important to both ourselves as ABSA and also to EABL. And then essentially from 10,000 shillings, then additional amount of 10,000 upwards. In terms of the payment, so investors have the option of either paying at the point that they apply, or they can pay at the point of allotment. I think typically what is that for your institutional investors, so your fund managers, banks, they tend to pay at allotment. So post offer closure, then retail investors, what you typically see is retail investors pay as they apply. And in terms of methods of payment, you can do it either through M-Pesa, RTGS, a banker's check. You can go straight to the bank to directly deposit the fund. A wide array of payment methods that have also been made available. I think from an investor perspective, the advantage here is that you can essentially get online, apply, and be allocated within 5 minutes of logging onto the link. And on the back end, we will immediately see your application. So if there are any issues, we're able to get back to you as soon as possible.
And in terms of early investor interest so far, how has been the reception from your perspective in the markets? I don't know how much of that you can share, but like from your vantage point, what are you seeing?
Okay, so at this time, we can't predict the final outcome, obviously. I think certainly the feedback has been very positive. But I think once you get closer to the closure is when we can actually share details. But certainly feedback has been very positive. And I think investors do understand, number one, the credit of EABL, and they appreciate that. And also the fact that EABL is a frequent issue in the market. And they've built quite a strong track record of delivering value for investors. So certainly we are seeing that from an application perspective.
Before I give you a break and switch to risk, maybe you can tell people how the corporate bond market looks like in Kenya, or how a corporate bond usually works for an institution that wants to issue a corporate bond.
Maybe I can first start off with the corporate bond market in Kenya. At one time, it was pretty active up until the period of right about 10 years ago where there were a few defaults. So after that, we didn't see too many corporate bond issues in the market. But I think what we're seeing now, and certainly you can look at previous issues that have come this year, but there's a lot of interest both from issuers such as EABL to come to the market and also from investors who are essentially trying to diversify their investments. And as mentioned before, there are not too many corporates. I think typically what is a lot of focus on government bonds. But I think with this particular issuance by EABL, I think it will not only just set a benchmark, I think, for blue chip companies when it comes to new corporate bond issues. But I also think we'll see a lot of issuers also keen to tap this liquidity just based off the fact that there's a lot of funds available, both from fund managers and also banks. So I think based off this particular transaction going forward, we'll see a lot more activity in the corporate bond space.
To whisper now, maybe you could repeat a few of the key numbers, especially in terms of debt ratios that are key that an investor should pay attention to. And then, of course, how the transaction shifts the landscape in terms of your fixed versus floating rate mix.
When we closed the financial year in July, we closed with a debt of 39 billion, of which 11 billion was the MTN that we have just paid out. So what this does is give us access to another 11 billion to maintain more or less the same mix. All the 39 billion that we had, we are fixing 11 billion for another 5 years. So that's what it does. From a key ratios perspective, we close net debt to EBITDA at 0.9. You want to keep that usually below 3. Our board has given us a target of 1.5 unless we have a very big CapEx investment. So we're well within that. From interest coverage, we were sitting at 5.5. Our target from the board is 4 times. So 5.5 times your interest cost is your EBITDA, which again shows you we're generating quite a good level of earnings to cover our interest cost. From a current ratio, we're closing at 1.11. And again, above the minimum, our board level is 0.8 and the capital markets ratio is 1. And again, we're above that. And from just a return on capital employed, we came in at just about 29%. We aim to be around the 30% mark, and sometimes we've gone up to 40%. So really quite a strong set of results. From a cash perspective, we started the year with 10.8 billion. We generated 35.7 billion from our operations, and we used that to pay out interest, taxes, to buy fixed assets, to pay out dividend, and to reduce debt. And we still closed the year with 12.7 billion. And again, a big focus on cash. From a CapEx perspective, we spent quite a period between 2020 to 2023. We had quite high CapEx. We were doing a number of investments in Tanzania, as well as our ESG investments in biomass in Kenya and Uganda, as well as water retention projects. So those required a bit more CapEx than usual. Within 2024-2025, we've normalized to a single digit to sales level of CapEx spend. So spending just about 7 to 8 billion. Last year we spent 6.5 billion. So again, no huge change in CapEx needs. And that means we will continue to be a strong cash generator. We'll continue to keep a strong balance sheet. And our focus is on growing the business and making sure that the balance sheet is stable to support that growth as much as possible. So really quite a strong set of results. And what this does is to continue to give us the balance sheet strength we need to continue to grow, but also to minimize or reduce the volatility in the P&L over the period, with about 30% of our debt being fixed versus floating, which helps us to manage whichever way the interest rates go.
So what I'm hearing you say is that you have the confidence to be able to repay back the money that you're borrowing from the investors.
Absolutely. I wouldn't go out if I didn't have that confidence.
Back to you, Robert. When an investor who's new, perhaps a retail investor, is giving you the money, that say the 10,000 shillings, what are they expecting from EABL every year until the maturity, and what they expect back at maturity at the end of the 5 years? So perhaps you can break it down for the retail investor, what they should expect.
So in terms of the structure for this particular issuance, so it's a 5-year bond where interest is paid semi-annually. The principal will be paid at maturity. So from an investor perspective, every 6 months, they will be getting the coupon payment. And then at maturity, 5 years from now, they'll then get the payment of the principal.
And then is there an allocation at the end of the day that is meant for retail investors, or will you determine that as and when you get all the orders in?
So that will be determined at the point the offer closes and when we're doing the allocation.
And then in terms of active trading, I think that's something that perhaps investors should be aware of, that once you give the money or invest in the medium-term note, there is an ability to trade in the secondary market. Could you explain that a bit and also give a bit more detail on how the secondary market looks like for this bond after it has been issued?
So typically, corporate bonds are not as actively traded in the secondary market as you'd see, for example, for government bonds. So most investors hold it to maturity. However, as ABSA, we are looking to provide secondary market support. So where we have investors that are looking to trade, we're happy to look at positions in which we can then provide a buy-sell quote. I think as ABSA, we are really focusing on making the corporate bond market more liquid from a secondary market perspective. And that's part of what we offer when it comes to corporate bonds that we support. We also look to support on the secondary market perspective.
So what does this issuance itself, at least from your perspective, Robert, say about liquidity and sentiment in the Kenya's corporate bond market? So we've seen a bit of a really positive sentiment on the equity side. I think it's been a good year at the NSE for most stocks. Is that translating to on the corporate side in terms of interest to invest there also?
Yes, definitely. I think from our perspective, this issuance reflects positively on both liquidity and investor sentiment in Kenya's corporate bond market. I think the view of the issuance, underscores the market depth and the appetite for high quality corporate paper. As mentioned before, we're looking at a wide array of investors, your fund managers, your commercial banks, insurance companies, and retail investors. And just looking at the various bids that have been placed, we've gotten bids from all across. So there's quite a lot of liquidity. And what we're hoping is that for future issuers, they'll also appreciate that there's quite a bit of liquidity that's available for corporate bond issues. So if you're looking at it from a liquidity perspective, certainly there's a lot of liquidity in the corporate bond market space.
And when you're marketing the note too, you're talking to institutional investors, both retail, you're welcoming everyone, or?
Yes, we are speaking to everyone. I'd say probably since the offer opened, we are speaking to a very wide array of investors, including retail investors. I've seen it's been really busy. It's a lot of questions, a lot of assistance when it comes to making the various applications online. So it's to the entire universe of the investor base.
And back to you, Rispa, in terms of the memorandum, one thing that I noted there myself is that debt levels won't rise. I think that's something the memorandum says. What does that mean practically in terms of the medium-term notes implications on debt levels?
It's just what I said is at the moment and with the projections we've done, this is not an increase. We're not just taking the 39 billion and adding another 11 billion to get to 50 billion. This is, we've paid down 11 billion of a debt and we're taking on another 11 billion. So it's replacing that, but it's fixing it for another 5-year period, which is good from a balance sheet management perspective. Also, at the same time, then if we do go up to 20 billion, again, it's looking at opportunity to, again, improve that mix or pay down certain debts where we see opportunity to get a lot more stability. The intent is not to raise our debt level. At the moment, we don't, based on our projections, we are sitting very comfortably from a total debt perspective. And so that should not see an increase in our debt levels.
So does that mean if you tap into the 9 extra billion, then that would be the increase, right?
No, again, even the other debt that's on our book is amortizing. So you would then be just sustaining the same level. We don't see a need to go beyond where we are currently. We wouldn't take money just for the sake of it. It's expensive to borrow money, so you never want to borrow it and have it sitting around idle, because we would be seeing an opportunity for even better balance sheet management or risk management if we see a lot more volatility coming in. And those are the conditions under we would be taking it, but not to increase the amount of debt that we are holding. What we do, and particularly what we found very useful, is that the capital markets are very good for long-term debt. For an issuer like us, any one bank, 20 billion is a big amount of money, or 11 billion is big. So they quickly get into the single obligor limit. And so you need 3 or 4 banks coming together to give you such an amount. So for anything that requires long-term funding, and a lot of them would have been done years ago, 5 years ago, but the funding then takes time for the asset to pay back. Then we try and match the long-term funding to our long-term needs. And then we largely lean on the banks for more short-term type of funding needs, which is more the working capital financing types of things. So that's how we structure it. And as I say, there isn't any intention to do anything big from a debt perspective. It's really purely just managing the book that we have, which at this point in time and over the next few years we think is optimal.
And what factors would determine whether you tap into another tranche within the next year or so? From your perspective, I know like you don't intend to, but from your vantage point right now, are there anything that can move you towards that 9 billion?
I think it's just if we see a lot more volatility and we want a lot more stability than we currently have, than the 30% being fixed. Or 2, if we just see that it's a good opportunity and it's at an attractive level where we can raise this without a very long process and use it to sustain the debt level. So it's really what we see and project the market will be like. And if there's an opportunity for even more balance sheet stability, then that will drive the conversation that we have and the opportunity to come back.
For Robert, perhaps, when I talk to a lot of investors, most of them have mostly been leaning towards the government bond market in terms of investment, the IFBs and the likes. But with this note, you want them to consider the corporate bond market as an area for investment. What's your pitch there for the investors to consider the corporate bond market as a space for investments to add to their portfolio?
I think if maybe I can touch on perhaps the RBA investment guidelines, you'll see that about 20% of it can be put in corporate bonds. And at the moment, it's probably less than 1% in total. So most investors, at least from a fund manager perspective, are underweight when it comes to corporate bonds. So I think it's a great way to diversify, number one. Number 2, it's a great way to have exposure to a great credit that is EABL. And it's also, I guess, just as a form of hedge as well, where I think generally you don't want to be too exposed in one asset class. I'm sure as a lot of us have learned in schools, you want to have exposure to different asset classes. So this really offers that to investors, and not just to fund managers, but also retail investors, to banks and the whole universe. But essentially, I'd say we don't see too many corporate bonds, especially from a strong blue chip names such as EABL. Certainly is an opportunity for investors to have exposure to such a name. And once again, looking at this relatively small amount that they need to invest in, which is 10,000 shillings, I think provides a great avenue for them to diversify their holdings.
Is it possible to size up the corporate bond market versus perhaps the government bond market in terms of numbers and key figures, and maybe also across the region and how they compare?
So I can't give an exact figure, but I would certainly say if you look at the entire outstanding government bonds that are in the market and corporate bonds that are outstanding, probably corporate bonds makes less than 1% of the availability of government bonds. It's really a drop in the ocean. And once again, for such an opportunity, and I think it's a great way for investors to diversify.
Definitely, and I think a blue chip like EABL would be a good place to start at. Now, moving on to risk part, in terms of OPEX and CapEx, how do you think about it at EABL in terms of currently? Do you have any CapEx currently going on in terms of investments that you're making across the region? maybe you can give perspective to that. And also, like last year, I remember there was some issues with working capital that were coming up. You got a reprieve later in the year. How's that going? Perhaps a small update on that.
I touched on CapEx. We did do quite a bit of expansion, largely in Uganda and Tanzania, and even in Kenya. We did a lot of sustainability type projects in the last 3 or 4 years. So in the last 2 years, we've seen CapEx spend come down. I think 2023, we were at about 13 billion. And then it came down to 7.5 and then 6.5. So you can see that is 6.5 billion, 7 billion is really maintenance CapEx, returnables such as bottles and such, and health and safety type things. So it's nothing big. Right now, we think we are adequately covered. Of course, all of that is influenced by the growth we see in the market and opportunities. So if a good opportunity shows up in a market where we see an opportunity for growth, of course, we will look at it. And we make sure that we are well capitalized and in a position to take that up. Otherwise, we give it back to shareholders and use it to pay debt as we've been doing. So really, CapEx still, my expectation is to remain in the maintenance zone. There isn't anything big at this point in time. However, as I say, all of those decisions are driven by market forces. And if we see big opportunities that we have to go after, then we do. But that's where our minds currently are. Your second question was working capital.
It was a bit of a struggle last year. I don't know how that's gone on, as maybe some reprieve from KRA.
Somebody very cleverly decided that we could pay excise on alcohol on a daily. That obviously is extremely challenging given that you produce, and I think they saw it's almost like betting. Whereas betting, you pay the money, you get your token, you win or you lose, and that's it. For us, you've invested in plants, you then buy materials, you produce that material, you sell the alcohol on credit, you collect it 30 days later or 21 days later. Then you pay excise, which is really a consumer tax. But now the rule that came in was that the minute you remove it from the store, then you have to prepay, which completely disrupts your working capital cycle. And you end up really tapping into short-term debt. And you saw that in the previous 2 years, that had a big impact on short-term debt levels and interest costs. We engaged extensively with the regulators, the lawmakers, and last year on the 27th of December, that was changed. And it was changed back to monthly by the 5th, which gives us room because you need a whole month, even from an administrative perspective. You need to reconcile your books, you need to close them, reconcile the numbers, and then calculate what excise you're due. Otherwise, you end up just prepaying to make sure that you don't miss anything, which was the challenge we were facing with the daily payment. Is it perfect? No. And to those of you who close books, you know that 5 days post-month and you haven't finished your reconciliation. So it would be good to adopt what we see in other countries and other markets, which is anything from 20 days to 30 days is what is normal practice. However, having taken the pains of the daily prepayment, for now we are taking the 5 days post-month, and as we look for an even better outcome that is more comparable to markets in our region and across the continent that have similar rules. So that has been helpful, to be honest, because the impact was really quite detrimental. And that has helped us with working capital management and interest costs for the time being.
Back to you, Robert. Someone is asking, maybe you can talk about the interest rates that are coming up on the MTN, and then also whether the interest payments will be taxed. I think someone is asking whether KRA will come for the interest payment in this regard.
Yeah. In terms of the interest rate, so it's 11.8%. That's an annual amount that's paid semi-annually. And then in terms of withholding tax, yes, withholding tax on interest for residents is 15%. So it is applicable. However, I think the tax status may vary depending on the particular investor. So for example, some pension funds may be fully tax exempt, but I think for the regular investor, whether it's retail, corporate, there is a withholding tax of 15%.
Someone looks at your operating cash flows and says that they're around 23 billion and says, does that leave you room to repay back the debts? I don't know what the context is, but we're just a little worried. Are you able to repay back if the operating cash flow you generated? I haven't double checked the number. It says 23 billion here. Do you have a response to that?
So we generated cash from operations was 35.7 billion in that 1 year. And remember, that is just 1 year in which we generated that, and we don't pay all of that out in the 1 year. Also remember what I said at the start, that it's perfectly normal for a business to be funded by debt. There is nothing wrong with having debt on your balance sheet. all of that debt matures at different times and has different rates. And also then making sure that you're managing that. When are my repayments due? And making sure that I fund that. And that involves different decisions like how much CapEx can I afford and what other things should I work with to make sure that as and when things fall due, then I'm able to repay them. And that's why we look at the key ratios that I talked about, which tell you that I am perfectly capable of covering the interest. I'm perfectly capable of covering the debt, and my balance sheet is quite strong. So you don't just take all the cash. Remember, this is a 5-year instrument. So you would have to take, in 5 years, do you generate enough cash for you to pay it when it falls due, plus the interest? And there are very many variables to play with. And that's why I say the most important thing to look at are our key ratios, which remain very strong. And maybe just to support that as well, please remember 2 years ago, F23, given some of the changes with KRA and the pressures we had at the time, we had debt of 59 billion. In the last 2 years, we've paid down 20 billion in debt to come down to 39 billion. So you can see our capacity to pay down debt is actually quite strong. Last year alone, we paid down 9 billion. So when we say this debt is expensive or we don't need it, we actually have the capacity to pay down debt quite quickly, and we've demonstrated that.
All right, Robert, now over to you. As we close the conversation now, perhaps you can reiterate the key numbers and dates people should keep in mind and maybe invite them to invest. And then I'll switch to Rispa to give a quick pitch on why people should join her on this journey by investing in the medium-term note, and then we'll wind up. Over to you, Robert.
The offer closes on 10th of November. So that's next week, Monday. As mentioned before, investors can apply both online. So you can go to the EABL website. We can get the link and apply online. As mentioned before, it takes less than 5 minutes to actually apply. If you do prefer to use physical forms, then you can actually do that. But I think at the end of the day, the key date is the 10th of November to place your applications and your bids. For my message would be to the various investors on this call is that there's about 6 days left in which you can invest. So basically from now up until Monday is when the offer will remain open.
Mine is really just to thank everyone first for the interest and for dialing in, but also to say that as EABL, we take our role in the society and in the capital markets very seriously. So doing this and putting out a note onto the capital markets is part of our responsibility in also developing our capital markets. It does benefit us to have a very active capital markets with a number of corporates, strong corporates who ensure that your money is safe and that you get paid back and you have options on where to put your money is. So it is part of raising funds for our business, but honestly, we can raise funds from other different sources. So it's part of looking at ourselves and saying we have a role to play in building our capital markets. A part of building our capital markets is giving people access to instruments like this one, which enable investors to have a range of things that they can choose and pick from and where they can put their money into. It does raise the profile of our capital markets as well. For us, for me, I do think it's an excellent investment. And I also think it's an opportunity to participate in a business such as EABL, in which you can participate in different ways. So this is just another way in which you can participate, get a good return, but most important, it's a good credit. So you feel really good that your money is going to come back. So, and you can do detailed studies of our numbers, of the prospects of the industry, and our ability to even withstand shocks such as COVID will tell you that this is a good company to be in. So I think it's something that we consider our role, and it's something that we take very seriously. And we also treat every single stakeholder very, very responsibly in our duty to manage your investment very carefully. So I do hope that we will see many more corporates, strong corporates with good credit rating coming out and being active on the capital markets as well. Yeah, but hopefully we've seen good interest, and that gives us confidence to keep coming back and doing this. Yeah, so I'll just say thank you very much for your interest and also for your participation.
A quick one. I actually wanted to ask you a question. When people invest in corporate bonds, by the way, in traditional assets, when you invest in them, you can actually use them as collateral to get a loan. How does that work in terms of a corporate bond?
So in terms of the market, I haven't seen that actually done. I think similar to, if some of you recall, back in '08 with the Safaricom IPO, people were able to get loans just based off the application from shares. I'm sure it is possible in the market. I don't think it's something that we see a lot, but certainly something that we'd be very happy to look at as ABSA. But I think maybe just as also a parting shot, there's a quote that I do, which is, don't just play the game, change it. But this issuance is more than a transaction to us. It's a signal of confidence in Kenya's corporate bond market and a testament to the strength of EABL as a blue chip issuer. I think at ABSA, we're proud to be playing a leading role in structuring and delivering a solution that balances issue needs with investor expectations, while also setting a new benchmark for blue chip corporates in the market. To the audience, thank you very much for the support that we've seen so far. We're really hoping that this will essentially be the transaction that will really ignite the corporate bond market in Kenya. So thank you, everybody. And we look forward to chatting more as we look to close the offer.
And perhaps you can tell people a little bit about maybe some of the services that you provide beyond helping out EABL.
Sure. So maybe I can chat a little bit about ABSA Bank Kenya. ABSA Bank is, as you all know, well-established financial institution with a heritage dating back to 1916. We are a tier 1 bank in the country, and we offer a range of services, which includes your retail banking, corporate investment banking, business banking, and wealth management. We're also part of a larger group with offices in 10 African countries, plus also in Europe, Asia, and North America. In terms of what I do, so I head up, as mentioned before, capital markets for East Africa at ABSA. So that's essentially bringing clients to the capital markets. So if it's from a debt perspective, as we're speaking of for this particular transaction, then we're supporting EABL when it comes to the issuance of corporate bonds. We also look at commercial paper, Euro bonds that the government has, and we have also supported on that. And then on the equity capital market side, we look at your IPOs, your right issues. So we essentially offer the full suite of capital market products, all done within the team that we have here in Kenya, supporting the entire region. And certainly when I look at over the years, the transactions that we've supported, I think we are very keen to support the growth of the capital market. And I think if you look at our track record over the years, it's something that we're very proud of. And I'm certainly very proud of being part of this transaction as well.
A quick question which has come in, maybe this for RISPA. I think someone has asked you, given that the MTN is unsecured, what safeguards or structural protections are in place to protect retail investors in the event of a default by EABL? I think this is understandable given a couple of people have been burnt in the past by investing in some corporate bonds. Perhaps you can respond to this particular investor who's a bit worried.
Let me take it. I think first, let me say all our debt is unsecured. Even when we had 60 billion, it was all unsecured. And where I'd say take comfort is in our cash generation, and our ability to continue to generate cash is the most important thing. Because even if I gave you the plant at Ruaraka, I don't know what you do with it to get your money. So the most important thing is, have I demonstrated that I can sell beer, I can sell spirits, I can collect the cash, and therefore I can pay you back? And do you have doubt that I can do that based on what daily basis, based on our transaction volumes, our just the strength of our distribution network, and our ability to really attract the consumers to come for our products? So I think even from a credit perspective, that's what gives confidence, even when we go to the banks, that from a cash flow perspective, our ability to generate cash flows is really very strong. It's one of the things I hope that we will be able to think about is really look at the credit of the individual issuer. And that's what sometimes makes it hard for corporates to come onto the bond market, is that investors need to understand what is it that makes me confident to put my money here. Usually it will be your ability to pay and your ability to continue to generate cash. And I think our biggest demonstration was going through COVID and coming out of it and being able to manage debt and manage the dividend and manage all the dynamics of the business, even under extremely challenging changes in regulation, etc. We've been able to demonstrate that. So I would say put your stock on the cash and the cash generation. It will be very hard for you to sell Ruaraka and collect cash. So the biggest, most important thing, even more important, in how much cash am I generating, and am I demonstrating an ability to sell beer even in your local that you can see, and you can see that actually nobody is drinking that beer on credit.
Closing thoughts, RISPA and then Robert.
Okay, I've said my bit. While I'm just grateful for the opportunity to play this role in the capital markets, looking forward to seeing more corporates, more activity, more liquidity, and more risk-based pricing continue in our capital markets for it to be the most vibrant, most liquid, most attractive capital markets in Africa and even beyond. So we do our small bit, and we hope everybody will come with us to do that, and that we'll continue to see even greater interest in making our capital markets one of the most vibrant, one of the strongest, and a really viable option for not just corporates, but also other businesses to come in, raise funds, and pay them back and consistently. So thank you so much for dialing in, for your interest, and for your participation, not just in this bond, but also in previous issuances. So thank you very much.
A quick one. What are you reading? Arispa.
I've just finished what is called the Let Them Theory by Mel Robbins, and now I've started on Francis Okomo's biography, which just came out. I've even forgotten its name because it's brand new and I started it today. Yeah, so I'll tell you about it next time. Thank you.
Thank you. Robert?
I think as APSA, we're proud to be playing a leading role in structuring and delivering a solution for the EABL bond that balances issuers' needs with investment expectations. So that's something that we're very proud of. And I think whenever we talk as a team at APSA, we always say that we're not just a bank, we're a partner in your journey. And whether a company, a client, or individual are looking to grow their business, invest in their future, or manage their everyday finances, we're here to help you bring your possibilities to life. I'd just say thank you to everybody who dialed in. We truly appreciate it, and we look forward to engaging further.
For those people who are listening in, if you go to EABLMTN.E, then -offer.app, you will get to the place where you can apply. Right now, there's a countdown timer there. It says 5 days, 4 hours, and 53 minutes to go before the deadline. So don't be the regular Kenyan who's waiting for the deadline. I just make sure that you apply before time. So once again, it's EABLMTN.E-offer.app. So you can get more information as much as possible there. I thank you for joining us and giving us an hour of your time. Arispa, Robert, thank you. Thank you for the team from APSA, the team from EABL, and all of you who have made this possible. And the team from Mango Capitals who are behind the scenes working so hard to make sure that we get these spaces every week.